Good afternoon, everybody. It is now Tuesday, April 5th, and we're doing back-to-back comments talking about fixed income and what is happening in the U.S. fixed income markets. So yesterday, you might want to check out that video. We posted a video talking about the yield curve inversion, which started last Friday. And today we're going to talk about just overall some other stats in terms of what's happening in the bond market. So bonds, usually the defensive piece of the portfolio, the piece that pays you some income, maintains that stability of principal. Generally speaking, for the last 40 years, investors have not been used to losing money in bonds, and we are off to a really, really tough start in the bond market. This is the worst start, just to put it real simply. It's the worst start in the fixed income markets, investment grade fixed income in this country since 1980. The Barclays Aggregate Bond Index is basically the broadest measure that we have of investment grade fixed income in the United States. So think the Dow Jones of bonds, the S&P 500 of bonds, that is the Barclays Aggregate Bond Index. And year to date, it's down about 6.8%, which is just a monumental move. You've got to go back to 1980 to find a start of the year that ended up being worse for bonds than what we've experienced so far this year. And really, there's a lot of things going on. Bonds go down in price when interest rates go up. We came off historically uber low, super low interest rates in the wake of the COVID pandemic. Interest rates are starting to normalize. Inflation is back. The Fed needs to be, and they are being more aggressive in terms of trying to keep up with that and trying to push that inflation back a little bit. And you're seeing that reflected in terms of yields. So there's a couple things I want to put into perspective today. First of all, where are the U.S. interest rates, where are the U.S. Treasury yields relative to what's happening around the world, just to give you kind of a picture of what's going on. And also why you would still want to hold individual bonds in this environment. So let's start and put this into perspective. So the U.S. 10-year right now, 10-year Treasury is currently yielding about 2.5%. That is historically still incredibly low. I mean, historically, you look back, yields are usually 5 to 6%. We haven't been at those levels in a long time. You got to go back to pre-financial crisis before you saw those levels. But we're still really at low levels that we really haven't seen since 2018, 2019 or so. But we went down to yields of about 50 basis points, about 0.5% during the worst of the COVID pandemic. So rates are starting to normalize. Yields are ticking up for sure. That's bad for the price of the actual bonds themselves. Not bad if you're buying bonds now, because it means you get paid more interest if you're buying bonds today. But if you're for existing holders of bonds, it's definitely added volatility to the pricing. But where does that stand relative to the rest of the world? So our 10-year bond, U.S. Treasury, which is really considered the gold standard in terms of the universal store of value for cash around the entire world, yielding 2.55%. You go to the United Kingdom, you go to England, you invest in their 10-year security, you're getting 1.6%. Sweden, you're getting 1.2%. Spain, which is an economic basket case, you're getting less than 1.6% if you buy their 10-year bond. The Netherlands, you're getting less than 1%. You're getting about 88 basis points. If you look at Germany, you're getting 60 basis points. Their yields were actually negative around the COVID crisis, which means you paid the government of Germany money to hold your money for 10 years. You gave money, and 10 years later, they gave you back less money. Not a bad deal for the government of Germany, not a great deal for investors. But their yields are still sitting about 60 basis points, basically, so a little bit more than 0.5%. France, 1.1%. So what you're seeing is, in many cases, our yields here in the United States are 2, sometimes 3 times higher than what you're seeing around developed Europe. So it makes a pretty compelling argument for cash and capital around the planet to begin to look at the U.S. Treasury bond as being a safe place, and at least a better place to be putting assets than over in the EU. Question I would have then would be about what about China? Not a very transparent financial system. If you think we have a debt problem in this country, take a look at what they have in China. They have enormous debt. Lack of transparency, just no one really even knows what all of it looks like. They're yielding 2.8%. So all of a sudden you look at our yields and it doesn't look too out of whack. So I'm not saying that yields don't continue to tick up. It wouldn't surprise me if you saw the 10-year tick back up to, say, about 3% or so by the end of the year. No crystal ball, but it just wouldn't be a bad estimate. And again, that would still be historically a super, super low yield relative to where we've been throughout history. But here's why we still will continue to hold individual bonds. When we buy investment grade, high quality individual bonds, whether it's a municipal bond, a taxable muni, whether we're going out to buying high quality corporate bonds, whether we're buying treasury bonds, when we're buying a bond, provided they don't default, which is why we're buying very high quality, single A, double A, higher investment grade bonds, we know exactly with mathematical certainty what our rate of return will be. It is a simple mathematical equation. When you buy a bond, just to make the math easy, let's say you buy a bond for $100,000 that matures out in 5 years. You get your $100,000 back in 5 years. You get your coupon payments, your interest payments that happen along the way. Depending on where market rates are, you might pay a premium for that bond, meaning you might pay more than $100,000 if the interest that they're paying you is above and beyond where the market is right now, and that's where you see some of the price fluctuation. But that yield to maturity, meaning the yield on your money, that we know the day we buy that bond, again, provided they don't default, which is why we really don't do much in the high yield space, to be honest with you. We want the highest quality fixed income, whether it's municipal, whether it's corporate, whether it's obviously the Treasury is kind of the gold standard, but you know with mathematical certainty what your rate of return is going to be. And when you see big price fluctuations like we've had in the fixed income markets, that math equation doesn't change. The income that you receive, the cash flow that you receive on that bond comes in two parts. It comes the interest payments you receive from the issuer, and it comes when you get your money back in the form of that repayment of that bond. None of that changes. The price does this in a year like 2020 where we had interest rates absolutely collapse. It was great because you look at the statements and these bond holdings that we had really went up quite a bit in value because you had bonds that were purchased at much higher interest rates when rates went pretty close to zero. People were willing to pay a lot more for that specific yield. Now you're seeing it's kind of start to normalize. But what you see is you'll see the prices kind of bounce around depending on what is happening in the interest rate environment. But again, if we hold that bond to maturity, that individual bond to maturity, unless the issuer defaults, which is why we don't want to play in the high yield space, we want to be in high quality fixed income, again, whether it's municipal, corporate, obviously the Treasury, we know with mathematical certainty what that bond will pay us, what the cash flows will be. Now, we might not love the return of principal that we get back in 3 or 4 years, depending on what inflation does, but we know we're going to get our money back again, provided that the quality of the issuer, that they continue to make those interest payments on time and pay that principal back on time. So that's why even in this environment, we're still wanting to hold fixed income. We're still wanting to hold individual bonds. It is the blocker. It is the stability in a portfolio. And you know what? Right now we're seeing yields working obviously against fixed income holders right now. But in the event that there is a rush to the exits in some of the more riskier assets, whether it's real assets, whether it's commodities, whether it's equities, traditionally speaking, you will see that money pour back into the highest quality fixed income investments as people look for that flight to quality, that return to safety. So I took a lot of time today. Bonds are kind of, it's traditionally been a pretty boring, safe part of the investing markets, which is why we want to own them. This year's been it's been a lot more news happening in the bond market, which is why I'm running a little bit long here. I'm pushing almost eight minutes or so. But would love to talk about this again. Open invitation, as I always do with these videos. If you stay with me now for 8 minutes, this is a really long one. And if you're curious about what's happening in the bond markets, if you're concerned about this increase that we're seeing in interest rates, if you're looking and seeing what's happening in the Barclays Aggregate Bond Index, but if you have questions, call myself, a member of my team, and let's set up a time to really dig into it, because this is kind of a thing where it almost can help with a visual if I show you on screen something in terms of just the price relationship of bonds versus what's happening in the interest rate markets. But our yields here are still way higher than most of the rest of the world. I still think U.S. fixed income is a far better bet than, say, Italy or Spain. Wonderful countries, great food. But if I'm going to park my money somewhere, it's going to be in dollars. It's going to be in U.S.-based assets. But again, it's been an interesting year, and the bond markets are adding some probably unwanted but unusual excitement. If you stay with me again now, 9 minutes, I will stop here. Thank you very much. Talk to you soon.